Welcome, everyone. Today we have three special guests. We have Brandon, we have Greg, and we have Dr. Saeed. Okay, so Dr. Saeed is a private money lender. Brandon from Renovo, he does rehab loans, and he also does commercial refinances. And then Greg from Homebridge, he does residential loans. Okay, so today we're going to be talking about lending, funding, and the different sources and options that you all have available. Okay, so welcome, Brandon. If you could please introduce yourself, Greg, and Dr. Saeed, that'll be awesome.
Sure. Brandon Global Financial, Senior Vice President here, which is a fancy way of saying loan originator. Focused on doing value add deals, so fix and flip or anything from a single family up to a 50-unit apartment building and everything in between. And then we've also got the ability to do long-term financing for single family up to 30-unit apartment buildings. And we can offer 5, 7, and 10-year ARMs, and then 30-year fixed on even up to 30-unit buildings. So I think that's a little bit of an anomaly in the market, being able to offer a 30-year fixed on a multi-family building of that size. So important distinction, I think. But Chicago-based, been doing it for 6 years. Worked with several people on this call. It's a great time to be in real estate, if you can find any.
Right.
Got to know where to.
Hello, my name is Greg Stack. I work for Homebridge Financial. We are primarily a residential lender, lending on buildings from 1 to 4 units. We do also do some business purpose loans on DCSR, debt coverage ratio, also on 1 to 4 unit buildings. Those are 30-year fixed. I've been doing this for 6 years as well.
Hi, my name is Sayed Ali. Can you all hear me? Hugo? Okay.
We can hear you, Doctor.
My name is Sayed Ali, and I've been a physician for about 45 years. I'm about to retire. I've been involved with Mastery, Andrew Holmes, and Rahul Visal's program for real estate investors for the past almost 2 years. And I've been lending as a private money lender since the past 2 years through my IRA. On the side, about 15 years ago, I acquired my real estate license also, just investing in my own real estate properties and things like that. So, and typically it takes me about 10 days to about two weeks or so to lend out on my loans as a private money lender. So that's my brief review. Thank you.
Thank you, Dr. Saeed. Thank you, everyone. Okay, so let's start with when and how you're going to use Dr. Saeed, Greg, and Brandon. Okay, so you're going to buy a property, right? That's the objective. So either you're going to wholesale this property, you're going to fix and flip, or you're going to buy and hold. So what are your options for funding? Okay, so we're going to divide these into pretty much 2 options. So it's going to be the front end, okay, and the back end, okay? So as I said, you have 3 exit strategies in real estate: buy and hold, fix and flip, and wholesale. We're going to focus on rentals and flips, okay? So if you're going to do rentals, then the front and back apply, okay? So for rentals, and rentals. And then we're going to talk about this in just a second. If you're going to do flips, only the front end applies, okay? And if you're going to do wholesales, none of this applies, because when you're wholesaling, you're not buying the property, you're just getting the property in the contract and reassigning the rights of that contract to an end buyer for a profit. So we're going to focus on front end and back end financing. Now, on the back end financing, which means that when you buy a property, you stabilize the property, meaning you rehab it, you rent it, then you need to turn your rehab loan into a long-term loan or rental loan. So you're going to have 2 options. Okay? You either go the residential route or you go the commercial route. Okay, so on the back end, we're gonna have two branches. So now let's begin with the front end. So when you buy the property, okay, again, you're either gonna do a rental or a flip. So when you buy a property as an investor, we're looking for distressed properties, right? What it means is that they are not in move-in ready condition. Therefore, you're gonna need to rehab the property, do the upgrades, kitchen, bathroom, flooring, paint, light fixtures, plumbing, electric, roof, windows, you name it, right? Hopefully it's not a go rehab. We suggest not to engage in go rehabs because your risk is gonna go through the roof. Now the question is, how do you buy the property? What funding do you have available to you? Since we're gonna be buying distressed properties, we only have two sources for funding on the front end, okay? For a rental or for a flip. We're gonna be using either Dr. Saed, okay, so it's private money lender, or we're gonna be using Brandon, okay? So Brandon, we're gonna call him hard money lender, okay? So what does that mean? They're both asset-based. They're gonna give you the money not only for the purchase, but also for the rehab, okay? And then once you buy, rehab the property, and it's stable, meaning that you have a tenant in the property, then we're gonna pay them off, right? So these are short-term loans that need to be paid off. So what that means is once you stabilize the property, you have to refinance on the back end, okay? So we're gonna take a step at a time. We're gonna focus on rentals for now, okay? That you need to stabilize the property, meaning get a tenant in the property, and then on the back end, you've got to refinance to pay off Dr. Saed or the rehab loan from Brandon, okay? So you're gonna have two options, go the residential route, and this is where Greg comes into place, okay? Greg from Homebridge on the residential refinance, or Brandon, okay? He comes here on the back end refinance for the commercial program, okay? So we're gonna take you in a road trip when buying the property. Okay, so let's get started. So we're buying the property, it's distressed. Let's assume it's a bank-owned property. You don't even have the utilities turned on. So you need to get funding from either a private money lender and a hard money lender. Now, the question is why? Even if you have the cash, to be able to grow in real estate, you've got to use other people's money. It is that simple. Otherwise, if you put all your eggs in one basket, you won't be able to grow exponentially in real estate. You won't be able to build a rental empire. Therefore, you've got to use other people's money and have as little money of your pocket stuck in the property. That is the key to recycle your money and buy and grow when building a rental empire. So now let's talk about private money lending with Dr. Saed. So Dr. Saed, if somebody comes to you and says, Dr. Saed, I've got a great deal on the contract. Now I need money to not only buy the property, but rehab the property. So can you please tell us exactly what you're looking for in that investor for you to give them the money?
Certainly. So there are two areas of due diligence from my perspective as a private money lender that I have to do. One is my reviewing who the borrower is. What is the background of the borrower? What type of experience that the borrower has in terms of being able to acquire and rehab cash flow properties. So what is the track record? Secondly, what type of financial background does the borrower have? I'm not looking for doing credit checks and those types of things, but at least somebody who is able to be financially stable through their own job or employment and so on and so forth, having their own business or what have you. Then comes the issue of doing due diligence regarding the property itself is concerned. So in that respect, what I need to know is what is going to be their ARV, what type of issues do they have they done home inspection? Is this a property that will be able to do the numbers? Are the numbers correct? And then in terms of how much of a duration of time are they talking about? Those types of things. And then, of course, other documents come into play, like the plat of survey, the FOIA, all those things that I need to take a look at. Myself, often at times, would like to visit the property, and those types of things. What is the exit strategy? You know, when they are done with their rehab work within a period of 3 to 4 months, or 5 months, or 6 months, will they be able to get refinancing on that property and pay me back my loan? That type of thing. So as a private money lender, we are always wanting to feel secure, both in the relationship with our borrower, as well as the type of property that they have acquired, you see.
Perfect. Thank you, Dr. Syed. Now, Brandon, if they come to you and request funding, what is it that you're going to be looking for in the property itself, right, the asset, and the investor, for you to give them money for both the purchase and the rehab?
Yeah, so the first and foremost thing, we're going to be looking to speak with an investor that's got a business plan. One and done is, not really what we're about. A lot of brain damage for both sides to just kind of go through that. So a focused business plan is the first thing. Somebody that's looking to take this serious. Somebody that's got some experience, maybe done, 1 or 2 with friends and family. And then from an asset perspective, something that fits within their business plan, right? They're going to buy a house. If they bought houses in the south suburbs and now all of a sudden we're going to do, a luxury North Shore ground up deal, that probably isn't going to pass the smell test, right? And vice versa, right? Understanding what kind of assets they're looking to do. And then, the deal itself, obviously we would all prefer, to Hugo's point earlier, lighter rehabs, quick returns in and out. Those are definitely attractive deals, especially if you're getting into rental games, rental business plan, because there's less surprises, we'll say, right? So there's less of a chance probably that you as an investor will leave more money in the project or have less surprises. And then ultimately we're going to look on the asset to understand what the purchase price, what the acquisition cost is, and then what the as complete value is. And we're going to lend on a percentage somewhere between 80 and 90% of the purchase rehab cost, right? And then we're going to look at the back end value and make sure, we'll do the lesser of cost, 80 to 90%, or the value that's created, 70%. Does everybody understand that difference there?
Can you explain that, Brandon, please?
Yeah. So here's just a quick example. If you're buying it for 100 and putting in 100, right? We would lend between 80 and 90% of that. So 160 to 180. And then if you take, let's say it ends up being worth 300, right? 300 times 0.7 is going to be 210. So we're going to do the lesser of 180 or 210. Does that make sense? Because we want to make sure the end value at 70% that you're refinanceable on the back end at least. Make sense? Now, if it was buy for 100, put in 100, and then it was worth 200, when you run that same ratio, it's 160, 170, or 180, depending on how high up we go. And then if you do 0.7 times 200, we're going to lend 140. So it would be the lesser.
Oh, I have a question for you.
That makes sense. Go ahead.
I'm sorry. So with the purchase of these properties, again, many times these maybe not all of them, I know we're not looking for gut rehabs, but let's say, do all your loans require having an appraisal?
Yes.
Okay.
Yeah. Yeah, I mean, we're we're more institutional than, say, Dr. Ali, right? He's able to make decisions and come up with values based on what he's able to pull from comps, if that's how he chooses to do it. But, from an investor standpoint, we have to make sure that we're papering the file with a true third-party valuation, just so that, Brandon doesn't get excited or really starts to like George, and, all of a sudden, well, all right, George,
Sure.
we like you. So, yes, we absolutely have to.
Okay.
But in the end, it's all to set you up for success, right? So that it ensures that on the back end, when you go to refinance it, if that's what you choose to do, that there's enough cushion in there so that you can get out of the deal.
Okay.
Also,
Now, Dr. Said,
also on flips.
go ahead, Brendan.
Yeah, also on flips, you want to make sure there's enough cushion that you're still making a good spread that makes the deal worth your time and gives you the proper ROI and all those things.
Now, Dr. Said, what numbers are you looking for when it comes to funding? Are you able to, because with the institutional money like Brandon, he wants investors to have skin on the game, right? So they need to have 10, 15% down payment. Now, whereas through you, private money lending, are you able to fund 100% of the purchase price and 100% of the rehab? What's your criteria?
I am able to lend on 100% of the purchase price and on 100% of the rehab. And because of the fact that there is more risk there in my type of investment, I have to make sure that their ARV, after everything is said and done, is of such a nature that they can come up with at least 70% of the ARV at the time of refinancing, so that I can be returned on my investment. So that is one strategy that I have to really do, and that is why I have a lot of intricate, exploration of the property itself and my relationship with my borrower. So, for example, if there is a problem later on where some type of problem occurs with the rehab, I would expect my borrower to come up with at least 5 to 10% of the value of the rehab to be able to fund that by themselves, rather than coming to me for an extra amount of money later on while the project is being done. So that type of financial security I do need from my borrowers. It's not like there are always risks when they're entering into their projects. Are they capable of handling some bit of risk in that from that perspective? Typically, my loans range anywhere from about 80,000 to about 150,000, even 175,000. I've got a loan coming up in about a week from now that will be 175,000. So those types of that's the ballpark of my lending. So that's basically what it is.
Perfect. Thank you, Dr. Said. Okay, so let's just understand when both Dr. Ali and Brandon say they need to have back-end value or equity. Let me give you a quick example. You buy the property for 100,000.
Mm-hmm.
Okay, so that's the purchase. You are going to put in 50,000 for rehab. Okay, so that's the rehab. This property better appraised for at least 200,000. Okay, so what does that mean? This is the ARV. What it means is that all in, you are at 150 between the purchase price and the rehab. So this property is going to look beautiful after you put in 50,000. So all in is 150,000. When the appraiser comes, this has to appraise for at least 200,000 or more. Why? Because when it comes time to refinance on the back end, if this is a rental, then they want to make sure that you have at least 25% equity or 50,000. So they're going to give you a long-term loan for 75% of the ARV. So if the ARV is 200,000, they're going to give you 150,000. What are you going to do with the 150,000? You're going to pay off the money that Dr. Ali or Brandon gave you, which is about 150,000, because both Brandon and Dr. Ali are going to give you the money for the purchase price and for the rehab. The only difference is that through Dr. Ali, he can finance 100% of the purchase price and 100% to the rehab. Whereas with Brandon, he will want you to have skin on the game, okay? So at least 10 to 15% down. So he's not gonna give you 100,000. He's gonna give you maybe 85 or 90,000, okay? So you're gonna need to come up with at least 15,000 down payment, okay, on the purchase. However, both Dr. Ali and Brandon are going to give you 100% of the rehab. The only difference is that Dr. Ali is going to give you the money up front at closing for the rehab as well, whereas with Brandon, it's going to be based on milestones of the project. So depending on your progress, you're going to request a draw, and then you are going to get partial installments of the rehab, right? So they're not going to give you the money up front and boom, because it's too risky, right? So they're going to make sure that they send an inspector to check the progress, and based on that and your scope of work, they're going to release the funds for the scope of work. Okay, so in other words, you're going to need to fund upfront expenses for the rehab when you use institutional funding or Harmony lenders like Brandon. Okay, so just for everyone to be clear. Now, let's talk about the terms of these loans. Dr. Syed, what are the terms of the loan as far as interest rates, origination points, and term?
So the terms are 2 points as a loan origination fee at the time of the origination of the loan, and then the rates are 12% payable monthly. So it will be 1% per month. And the duration typically is anywhere from 4 to 6 months. Not longer than 6 months, because if it extends longer than 6 months, and I've seen a question from Bill Latham regarding the duration, if it gets extended longer than 6 months. So if it extends, let's say 6 months and a week or two, I don't really make a big deal about it. But if it starts extending longer, then it limits my ability to be able to recycle my funding. So that is where then, according to my documents, my terms, I do charge at 2 points if it is extending beyond 6 months and going forward. But if it is just a week or two, I really don't make a big deal about it.
That makes sense because it's the opportunity cost, right? You could lend that money to another investor, right? So it makes total sense. What about you, Brandon? What are the terms?
One question, I'm sorry, Dr. Syed, I'm so sorry to cut in. Is that a straight interest loan where you're just paying interest, or is it principal and interest, Dr. Syed?
No, it's actually interest, but it's being paid on the principal because the loan upfront is not being given in the form of, periodic loans like draws. There are no draws here. So you're getting everything upfront right at the start of your project.
So example, Dr. Syed is going to give you 150,000. So he's going to charge 1% of the total loan amount, which is 1,500 interest only every single month.
Sure.
Does that make sense, George?
Yes, absolutely.
Perfect. Thank you. Brandon, what are your terms?
Typically 1.5 points, and then high single digits to low double digits on the rate, depending on experience, credit, in the project. And then typically 9 to 12 months is the duration.
Okay, so it's very comparable, okay? So the advantage with Brandon is that if you have a lot of experience, you're gonna be able to get a lower rate, right? Most private money lenders are going to give you starting like 12%. But again, it's all negotiable. with experience, you're going to get better terms. But overall, it's not cheap. But guess what? You're leveraging other people's money, and that is the way to grow. Even if you have the cash, it's best to use their money 100 times, okay? Now, let's talk about requirements. So the documents that they're going to need to sign, right? So I understand you need to have a promissory note, a mortgage that is going to be recorded, so first position lien. You're going to need to have assignment of rents. You're going to need to have the insurance policy being the beneficiary. And the borrower is going to be the guarantor on the loan. Is that correct for both, Dr. Syed, Brandon?
So typically, I require the guarantee. If the borrower of mine has got an LLC, then we require the guarantee. If it's under their name, then I don't require guarantee. Then there are other documents too, like affidavit of loan proceeds, and also like the plat of survey, FOIA, those types of things, and then of course commitment for title insurance that we need. Those types of documents, come in handy, are needed. So basically, that would be something.
Brandon, are there any additional documents?
I mean, those are closing related loan package documents. We would need application, a list of the experience you've done so far, and then also 2 years tax returns and 3 months bank statements.
I would also add.
Okay, what about reserves?
Sorry.
Oh, go ahead, Dr. Syed.
Go ahead, Doctor.
Go ahead. Why don't you finish, Brandon? Then I'll.
Yeah. So reserves typically on a flip, we're looking for post-closing cash to be 6 months reserves of your personal obligations.
Yeah. So I also need if it's an LLC, then we require the LLC documents. The operating agreement and their filing with the state and so on and so forth. So we need that also. I do go over when it comes to also looking at if there is any problem with the title insurance, if there is any cloud on the title or anything like that, that we really have to look into it to make sure that they have all the appropriate necessary information about that in the documents.
Perfect, thank you. Now, let's move on to once you've been given the money, right, for the purchase, either through private money lending or institutional money, right? You purchase the property, you rehab the property, and then assuming we're going to do rentals, you're going to stabilize, meaning get a tenant and have a lease in place. Now, at that point, few months have gone by between the rehab and market time, right, to get it rented. At that point, now it's time to pay them off, right, because it's short-term loan. So now let's move on to the back end refinancing, right, because you've got to pay them off between 4 to 6 months, as you heard, but for institutional money, they're going to give you more time, 9 to 12 months. So now let's assume that now you got it rented. Now it's time to refinance and pay them off. So at this point, Greg from Homebridge is going to come into the picture. He's going to have a residential refinance program, and so will Brandon. He's going to have a commercial refinance rental program. Okay, so let's talk about those. Greg, can you please explain what your requirements are for people to be able to successfully refinance on the property so that they can pay off the rehab loan?
Sure. I mean, we're really looking for credit in the 700s. 680 will get it done if it's your first one or two. You need some reserves. Reserves go up depending on the number of properties. If you have between 1 and 4 properties, it's going to be 2% of the total unpaid balance. If you're between 5 and 6 properties, you're going to be 4% of the total unpaid balance of all mortgages. And if you're over 6 properties, it's going to be 6% of the unpaid balance of all mortgages on reserves. We will give you 75% of the appraised value or what you have loaned out on the property plus fees for refinancing, whichever is lower.
Okay, now what if they have less than 680 FICO score? Then what happens?
If there is less than 680 FICO score, they're either going into some kind of business purpose loan or possibly a commercial loan with Brandon.
Okay, now Brandon, on your end, what are your requirements to be able to now turn this rehab loan into a rental loan?
Yeah, so 3 months of seasoning. You have to have owned it for 3 months for us to be able to use the loan to value metric versus loan to cost. We need to have 1.2 debt service, typically. You guys are going to want that as well. And then typically like to have credit over 680, but we can ask for exceptions. Your pricing will be better at 680, 720, 740, 760. And then obviously we need a lease in place. And then from a reserve standpoint, we would need 3 months PITI for loans 0 to 1 million. And then 1 million to 2 million, we need 6 months. And then for loans over 2 million, we need 9 months of PITI.
Okay, thank you. So Brandon mentioned two points, very interesting. They need some sort of seasoning, right? At least 3 months from the time you purchase the property. Let's assume you purchase it in December, end of December. You won't be able to refinance the property before end of March, okay? He needs 3 months of seasoning. What about you, Greg? What's your seasoning period?
If they have debt on the property when they purchase it, meaning they've gotten a loan with Dr. or with Brandon, we can refinance that loan right away. So as soon as the property is ready.
Okay, perfect. So 0
requirement if they
seasoning.
bought it with a loan. If they bought it cash, then they have to wait 6 months.
Really?
Okay, so let's just clarify that with cash or with a loan. I mean, when Dr. Saeed wires the money to the title company, it's like cash, right? So what we need to, correct me if I'm wrong, what we need to make sure is that the loan, the mortgage, gets recorded also in the HUD. Okay, so he's going to record the mortgage as a first position lien, plus it has to show on the HUD to show that it's a loan. Is that correct?
Right. We need a recorded mortgage with the county. You record, and then you have it on the closing statement. And as long as all the paperwork is correct, then we can do it as a rate and term refi without a seasoning period.
Okay, perfect. Now, Greg mentioned a great term. He said rate and term refinance. So what does that mean? What it means is that if you bought it for 100 and you rehab for 50, they gave you the 150,000. What Greg is saying that he's going to be able to give you the exact same amount, 150. But what if the property appraised for over 200,000? Let's say 250. You're going to have over 40% equity. Now, what if you want to cash out, right? So, Greg, can you tell us if they want to do a cash out, not a rate and term, right? So not only pay off what they owe, but they want to cash out.
Yeah, if they're looking to do a cash out, then they've got to wait 6 months from the purchase date. From the purchase date of the property, they'd have a 6-month waiting period.
For a cash out. Even if they have a mortgage, a loan, everything recorded, 6-month period.
If they're trying to do a cash out, it's going to be 6 months.
Does the term or the rate change if they're going to do a cash out?
It does. There's going to be a higher rate on a cash out as well as more points.
Can you tell us more about the terms, like the interest rate? Because if you go residential, you're asking for a lot of requirements, but you're getting a lower rate. So tell us more about the rates and the terms.
I mean, there has been some additional restrictions with Fannie Mae lately. Most of these type of loans I see pricing at about 4 points and about 4.5% right now. Fannie Mae has put some additional restrictions on investment lending, which has really kicked up the points on these. The rate's not so much affected, but the points has been, because they're not being sold to Fannie Mae anymore. They're being sold to hedge funds at the end.
Greg, if I may interject, if I may ask a question of you, what is the philosophy, what is the reasoning behind this 6-month seasoning, given the fact that the rates are going to be higher in a cash out?
That's a Fannie Mae rule.
I see. But do we know where they are coming from? Why is that the case? Any thoughts about that?
That's just as has been for quite some time.
Got you.
So I don't really have a reasoning behind that. I'm just going by the rules that are given to me. So, I mean, it used to be a year, so we're doing better than we were.
Got you.
Thank you, Greg. Now, Brandon, on the commercial. So commercial means that the long-term rental loan is going to be given to your entity, your LLC. Of course, you're going to be the personal guarantor as an investor, but that's the only difference, right? Whether the loan is going to be under your name or if it's going to be under your entity. With residential, you're going to be able to get lower interest rate. However, you can have up to 10 residential loans under your personal name, whereas commercial, the sky is the limit. Now, Brandon, what are the requirements on the commercial refinance?
So like, we talked about before, it's must close in an LLC, 3 months seasoning, and then 680 credit or above, 1.2 debt service, and then we can do anything from a single family up to a 30-unit apartment building.
And what is the rate they're looking?
Typically mid to high 4s and 1 to 2 points, and then depending on leverage, cash out, duration, the rate can go up to low 5s as well.
Now, if they want to do a cash out, will the seasoning period be extended or still the same 3 months?
It's for 3 months, yeah. 3 months, yep.
Oh, Brandon, I have a question.
Okay, great. Now, you mentioned, go ahead.
I'm sorry, if you buy the place for cash and then you want to, you want to do a refinance into a business loan, do you have a seasoning requirement on that too? Is it 3 months too?
3 months for ownership.
I'll have to check on that because I just put out new guidelines a few hours ago on that. So I haven't had a chance to read it yet. It's like about 150 pages. So.
Okay, thank you.
No problem.
Yeah, so we worked very, very hard with one of the hedge funds that's a big buyer of ours to come up with the 3-month guideline because values and things are moving so fast in locations like Texas, and then some of the other Sunbelt states that some of our other loan originators asked for that requirement. So, that was something that we were able to work on and come up with those guys, I think, individually. But in Chicago, I don't know that values move as fast, but when you're doing improvements, it still makes a difference, right? I mean, when you're buying and putting in 15 or 20, you're still improving the nature of the property and the value.
Okay. Now, Brandon, you mentioned debt coverage ratio of 1.2 and above. I know that is a critical ratio for lenders. Can you elaborate a little bit on the debt coverage ratio? What is that for? And
So typically what we're doing is taking the gross lease amount. So if you're renting it for 1,000, right? And then discounting it by 5% for vacancy. And then we're taking the PITI for 1 to 4 unit properties and assuming taking what that monthly payment is, and then taking the lease minus the 5%, making that your numerator, and then putting the PITI payment as your denominator. And then when you do the math there, the ratio must come out to at least 1.2. We can actually, in some instances, go below 1.2, but from a money making and cash flow perspective, typically I advise investors to be at the 1.2. It's pretty old driving the properties and fixing issues when you're not actually truly getting any cash flow from them.
Right. So, friends, in a nutshell, they want to make sure that your rental income minus your operating expenses, meaning your net operating income or NOI, will be sufficient to pay off the debt service. And that you also have a surplus of about 20%. Okay. So they want to make sure that you have a cash flowing property. So that ratio is very critical for lenders. So let's just quickly summarize what we've talked about. When you buy a property, 100,000 and 50,000 rehab, you have the option to use Dr. Syed or Brandon, right? Asset-based lending. They're about the same terms for the purchase and the rehab. With Brandon, you're going to need to have some skin in the game. However, with Dr. Syed, you are going to be able to fund 100%. Okay, so that's one of the biggest differences. Now, once you stabilize the property, meaning you get a lease on it, then you're going to be able to refinance, and you have two options: to go the residential route or commercial. Residential, Greg comes into the picture. Requirements are higher, as he mentioned, right? FICO score needs to be at a certain level, but you're going to get the lowest interest rate. But you have a limit of up to 10 loans versus commercial is unlimited. Okay. So is there anything else that, any other questions on the line that you would have for Brandon, Dr. Syed, or Greg? Anybody?
Are you able to lend? I think you guys did cover this. You're able to lend, you said, in Texas and also Florida, correct? Most of you guys?
Correct.
George, I do not. I lend around the Chicago and suburban areas, but not outside, up to Indiana and in those areas too, but not outside of that.
Okay. And can I ask Brandon and Greg? So you guys are selling your loans to hedge funds. So they're the ones that are servicing it, or they're selling it to another person to service the loans. Is that correct?
That depends. We keep about 50% of ours. So it just depends on if you get bundled or doesn't get bundled.
Okay.
So I don't really have any control over that. They'll kind of clear out sections of loans every few years, just recapitalize.
Okay.
So we could be servicing it. Somebody else could be servicing it. Like I said, we keep about half.
Okay.
We service 100% of our loans.
Okay.
I also service my own loans. Thank you.
Okay.
I mean, you're really kind of, to be fair to everyone, there's really small sections of the marketplace that fit correctly with me and fit correctly with Brandon. Like, if that person is highly qualified, you're going to want to build that portfolio out, the first 10 loans in your own personal name, and have 30-year fixed rates that are never going to change on properties that you're going to keep and never refinance. Where I also have a business purpose product that'll go down to 1.0 debt coverage ratio, but like Brandon said, that's not really a profitable property, but if you need to get out of a private money loan, it can help you out of it.
Sure. Okay. Thank you.
So, I mean, there's a lot of people that, I might give to another lender if it's not the right fit. So the first part of it when I'm really talking to somebody is just sorting it to make sure it's the right fit.
Okay.
Now, for a question for everyone, what advice would you give to somebody new in real estate, right? That they do have the reserve, but they may not have the experience, but they have a great deal on the contract. What would happen then?
So if I may take that, now let Brandon and Greg also speak. So very quickly, everything regarding my situation is concerned, it depends upon relationship. What I would like my borrower to do is to get in touch with me before they have acquired the property, so that we get to know each other, we understand what we are about, what my requirements are, how they do their due diligence, how they go about doing whatever they're doing about their project. Then when they acquire the property, then everything becomes a piece of cake. So that is basically, in a nutshell, what I would suggest to them.
Looks like Bill had a question about purchasing an LLC and then refinancing in a personal name. Yes, we can do that, but we need to refinance into the same name as the person that owns the LLC.
Brandon, is that the same for you?
No, everything we close in has to be an LLC.
Okay.
For going with an LLC to a personal, you do a quit claim deed at closing to move the property when you close on the loan, closing in your personal name. So that happens at the same time.
Okay.
What advice would you give to newcomers in real estate? I mean, that they're eager to buy rental properties. They do have great credit. They do have some reserves, and they're getting some deals on the contract, but they don't have experience, like 2, 3, 4 properties under their belt. What advice would you give them so that when they send the contract over to you, it goes through underwriting very smoothly and they get funding?
Yeah, I mean, the first thing would just be pre-approved first. So have one of us look at this, before you go out there trying to start looking at properties, and because the realtors are just going to send you right back to one of us, or, to either be pre-approved or have a proof of funds. The second thing is there's no shame in partnering with somebody with more experience. And then also, just getting the education so that you're ready when you go into a property by yourself.
Okay.
I would add to what Greg just said, and that is, if it's their first project, I would encourage them to go with a GC rather than doing everything by themselves. Secondly, to have their team in place, who are going to be doing the rehabbing, how are they connecting with the village inspectors, how are they going to be managing the whole project week by week, and that sort of thing. And if it's a first project, it can potentially become a nightmare. So I think it's very important to perhaps start the first project with a GC that is reliable and that can consistently give them proper, returns for the type of work that they're expecting to be done.
I totally agree on that. I'd say, interview quite a few GCs before you even go look at a property and decide, who you're comfortable working with. Because if they walk off the job, that's how, these things become a disaster real quick.
Mm-hmm.
Yeah, the only thing I think I would add to that is aim small, miss small. You know, maybe do a condo or a townhome or something like that to get started. And then also just be open to coaching and then getting uncomfortable and get ready to have those arguments with contractors. So yeah, it's a fun industry, but starting small and I think is the best way to go.
I mean, the better you set up your scope of work and have less changes through the project, you know, the more you're going to keep your costs under control. Because a lot of the cost overruns come where you're constantly asking your contractor to make changes, and then they add that all up at the end and present you with a bill.
And also, I would like to add that, at least for myself, I would like my borrowers to be very open and upfront with me, to keep me posted if they're running into a problem. We all are human beings. We can make mistakes. We can sometimes miscalculate, but at least keep us posted. Let us know how things are coming along, and particularly if there's a problem, if there's a bottleneck coming along, so that we can be more educated about it. That's all. And good communication.
Anybody else? Any other questions for the panelists? Okay, so I would like to share one of the new projects that we have is that we created two groups, the wholesale inner circle group and the cash flow inner circle group, okay? So the cash flow inner circle group is for investors interested in doing rentals and flips. So what we've done is we partner up with many private money lenders, raising over $1 million in cash to fund your deals. The terms are going to be the same as private money lending. So 12%, 2 points, 6-month term. Okay, so that is something new that we just created about a month and a half ago. So we're super excited to help you get funding for your deals. And obviously, we're going to make sure that you meet the requirements stated by all our panelists so you're not stuck on the refinance, right? So we're super excited about this project. I just pasted the link via the chat. If you guys want to learn more about the cash flow inner circle group, we have over 70 people as part of it. We meet every Sunday at 1 p.m. Okay, all virtual, and it's been super excited. We already we've funded 2 deals, and it's been very exciting. So we go over a 10-week module. I mean, it's about 10-week module, deal reviews, and it's been super exciting, right? We show you the A through Z blueprint on how you can build a rental empire. So that's the objective of that group. So if you're interested, please send us an email to support@chicagodealvault so that we can send you the invite for our next meeting, which is Sunday, 1 p.m. Okay, and we're going to have an in-person meeting this Friday at a coffee place in Chamber. Okay, we're going to be talking about shadow inventory and getting you vetted to have access to that inventory. Okay, so if no further questions, I'm going to remain on the line for the next few minutes. And I want to thank you, Dr. Saeed, Brandon, and Greg for joining tonight, sharing your experience. It was just incredible. Be able to have so much brain power and knowledge and funding capabilities with us tonight.
Thank you.
Thank you.
Hey, Hugo, it's Ray Johnson. I joined late. Sorry I missed a lot of it, but I wanted to ask you what we need to be. I'm going to start my LLC, and I want to know what we need for articles of organization and bylaws, etc., to set that up. And
right, you're going to need your entity reserves. Oh, Brandon, do you want to take that?
What's that? I mean, you know, you'll need an LLC, you'll need an operating agreement that details who the manager is and who the members are, and then the articles should mirror who the manager is as well.
I'm basically setting it up with my brother, who's my partner, so it's just the two of us.
Okay. Then you should both expect that you'll probably have to guarantee the loan.
I'm just wondering when we form it, what do we put in the organizational articles, etc.
You'll both be managing members typically.
Hey, Ray, I'm going to get you in touch with two of our accountants, Andrew Thomas and Patrick Noon. They're going to be able to help you set it up the right way, either an LLC if it's two or more, or if it's only yourself, an S-Corp, that's what we recommend. But if it's you and your partner, I recommend an LLC. But we're going to send you the contact information, which is in Dealvault on their preferred partners. Oh, by the way, that's how you can find Brandon as one of our partners on their preferred partners, and then go to Harmony Lenders, okay? And on their lending, you can also find Greg on their Homebridge. He's the only one for residential that we currently have, and then Brandon is on their Harmony Lenders. He's on the second page. So that's how you can find his contact information.
Ray, are you guys going 50-50, or is one of you the majority partner?
No, we're equal partners.
Okay.
So I just had a question just for clarification purposes. So if you're doing the loans on the LLC, you're not giving a personal guarantee? Or are you giving a personal guarantee?
If it's one of mine, it would be a personal guarantee.
Okay. That's what I
Typically,
thought. Right, that's what I
yeah, it's
thought.
going to just go under your personal name because it's going to be easier to close, and we're just trying to remove barriers from getting it clear to close.
Right, exactly. Okay. That's what I thought, but I just wanted clarity, that's all. That's fine.
Yeah, you're going to close in the typical process would be closing your personal name, and if you want to move it into an LLC after the fact, that's up to you.
Okay.
I'm going to share my screen to show you how to get in touch with Brandon and with Homebridge. So right here in Chicago Dealvault, on their preferred partners, click on Harmony Lenders, and Brandon is right here. All his contact information. And then for Homebridge, Juan Loya or Greg, go on their lender right here. Okay, so that's how you can get in touch with either one of them. So thank you everyone for joining. I'm gonna remain on the line for the next few minutes in case you have any questions, anything that you need clarification or help with. But again, thank you very much, Greg. Thank you, Brandon, Dr. Saeed. Awesome presentation.
Yeah, I just put my contact info in the chat as well. If anybody needs additional questions or wants to chat one-on-one, you know, they can give me a call or send me an email, and then we can talk.
Perfect. Thank you, Greg.
So at this point, I've personally done probably about 100 of these back-end refis. So, you know, pretty experienced with the overall flow from the beginning to the end.
I have a question for Greg.
Thank you, Greg. Go ahead.
I had put it in the chat, but I'll just go ahead and ask. We had bought two properties that only have an ARV of $90,000 each, not knowing that we were going to end up not being able to finance them because they're lower than 100,000 or whatever. So my question is, in order to be able to get a loan, and I think you said your minimum was 100,000, can those two properties, which are both held in an LLC, by the way, can they be combined together into one loan in order to be able to qualify?
I don't have a way to do that on the residential side. That you're probably going to either end up with either a commercial loan, smashing those two together, or possibly using what would traditionally be thought of as a HELOC, but putting it into first position. So it's
Okay.
definitely an oddball situation, because you
Right.
also have what they call ATR-QM issues on that, which is supposed to be consumer rights from the state and from the
I'm
county.
familiar. Yeah.
Yeah, but it ends up hurting in these types of cases because the fixed costs of doing the loan are such a high percentage that I end up with compliance issues. And that's really where our minimum came in, because we had to draw a line of how many of these compliance things we were just going to try to fight.
And so you're only doing residential. You're not doing commercial at all? Homebridge doesn't do
We're doing
commercial?
a business purpose loan, which is not quite, it's kind of a tweener. It's not quite commercial because it is a 30-year fixed, and it is based, but it is based on the debt service ratio.
Okay.
That is a hedge fund product, not a Fannie Mae product.
Okay. Does it have similar
It does
points
have
and
similar price
interest
points.
rate and all that?
Interest rates are actually going to be a little bit higher on that, but qualifying is going to be easier because
Okay.
all it's really looking for is the property cash flowing positive at all.
Okay. Yeah. Yeah. Both of the properties are cash flowing. That's not the problem. It's just that when we bought the two properties, we did not know about the minimum thing. We just thought, oh, yay, these are nice, cheap properties and we can get a decent rent, not realizing that,
Unfortunately, it happens a lot at the beginning. You know, my advice on that is, you know, and anybody that I've actually talked to on the phone is try to get your ARVs to be around 160 or greater, so
Right.
that when you go and you get your appraisals, your loan amounts come in, you know, 120 plus, your pricing on the loans will improve, as well as the fact that the properties that tend to not appraise out are below 160 ARV. They have appraisal issues on things below 160 at a much higher percentage than things that are above 160.
We've been doing this for almost 25 years, but when we were buying small single family homes all of that time ago, those regulations weren't in place. We could buy a house for $50,000 and get a 30-year fixed on it immediately. So we had gotten out of purchasing homes for a while, and then when we went back in, we purchased these two homes right out of the gate, and then found out that we might have trouble getting financing put on them.
Unfortunately, the two gentlemen that you're looking for are Senators Dodd and Senators Frank,
Mm-hmm.
and they have been kind of a pain in the butt.
Okay.
So,
Okay. All right. Well, thanks.
both retired now, so
Do
of
I
course.
have to hunt them down?
Yes, yeah,
Okay. Thanks, Craig.
no problem.
Hey, Rebecca, I think the solution to your problem would be to combine both properties going commercial, and that's what we're doing right now with Brandon. We don't have the issue of the loan being too small, less than 75,000, but we're just doing, it's called blanket loan, and Brandon can handle those on the commercial side, where you combine them both, two properties, just one payment. So that should resolve your issue of having a small loan amount on those two
What would
properties.
happen? What would happen if we've got the two houses? They're almost identical. They're in Park Forest. They're rented. They're cash flowing. They're just fine. But one of the tenants says in a few years that they might want to buy the house from us. So at that point, what would happen with that combined loan if we want to sell one of the houses that's in that combined loan?
Usually there's a prepayment penalty on the commercial side, 1 year, 2 year, up to after 5 years, no prepayment penalty. But you're not gonna pay off the entire loan because you're only going to sell one property, so
Right.
you're not paying off the entire loan. So you're paying a partial amount of the loan. So the prepayment penalty does not apply. It only applies when you pay off 100% of the outstanding balance, right? Like what they want is to prevent you from refinancing and leaving them out of the equation, right? At that point, boom, they're gonna penalize you. But if you're just making a big payment towards principal because you sold one of the properties, you're gonna be in good shape.
Okay. All right.
Does that make sense?
I would discuss those terms going in with whoever your loan officer is, because it sounds
Right.
like it would be recast at the point of sale because you're taking collateral out of there too.
Right. Okay.
So,
Great point, Greg.
yeah. But what you would really hope is that they escalate in value and then you refinance them out residentially at some point.
Yeah, right now we can't do
No,
residential.
Gigi. No, Gigi. No,
We
no.
have to do commercial.
Right. No, I'm talking down the line. Or,
No,
or
down
even
the-
two separate commercial loans down the line. Like
I
maybe
see,
you
okay.
combine them this time and then 5 years down the line you separate them. Something like
Okay.
that.
Okay.
So, there's more than one way to skin a cat, so to speak, but it's just kind of talk about it going in so they know it's a possibility.
Right. So no surprises, and then
Yeah, exactly.
like we got when we tried to get them refinanced and found out that nobody would do it. That was
Yeah.
a kick in the butt. Oh,
As far as residential lenders with the lowest loan limits, I have seen First American Bank do some stuff down in that range, but that was several years back as well. So somewhere
Okay.
you could check. Yeah, unfortunately, government's been our biggest challenge over the past couple of years here, between regulation and then the Fannie Mae trying to restrict investor loans.
Okay.
So a lot of this is moving more towards the business purpose and the commercial, except for like really highly qualified people. Just to be upfront about it.
Okay.